Well, hello, everybody. My name is Jimmy Atkinson. I'm the founder of the Opportunity Zones database at opportunitydb.com, and I'm also the host of the Opportunity Zones podcast. And I'm pleased to co-host today's webinar with Jeff Feinstein of Pinnacle Partners. And joining us today, we also have Jill Homan from Javelin 19 Investments and John Sciarretti of Novogradac and Company. So just a few things to go over before we officially begin. First of all, this is not investment advice and it is not tax advice. It's not a solicitation to buy or sell any securities. Please do check with your tax advisor or investment advisor before making any investment decisions. Without further ado now, I'd like to introduce our first speaker today is going to be John Sciarretti with Novogradac and Company. Novogradac, for those of you who don't know, is a professional services firm that has really had its finger on the pulse of the Opportunity Zones industry and the Qualified Opportunity Fund marketplace. They've been involved with Opportunity Zones even before the legislation was passed. And they track over $20 billion in Opportunity Zone investment through their rolling survey of qualified opportunity funds. So John, to you, I was hoping you could give us an industry update and your evaluation of momentum in the Opportunity Zone industry, particularly with regards to investing, capital raising, in light of possible tax changes coming to fruition in the near future, and also that expiration of the 10% basis step up, which goes away at the end of this year. So John.
Thanks, Jimmy. Yeah, I guess as Jimmy said, we are a traditional accounting firm, Novogradac. We started out in tax credits, and we were very fortunate to get involved with the Opportunity Zones early. It's interesting that the history of Opportunity Zones, it passed in 2017, but we didn't have final regulations until 2 years, until the end of 2019. And as a practitioner, we saw activity really start to accelerate after those final regulations were passed, and folks sort of knew what the rules were. And then along came the pandemic. So it kind of had that pandemic pause in the program. 2021 has been a fantastic year for Opportunity Zones. There's really no accurate public look, I would say. There's been some data. There was a couple of economists, Kennedy and Wheeler out of Berkeley, and in conjunction with the Joint Committee of Taxation, they actually were able to derive data from 2019 through the electronic tax filings. About 75% of taxpayers file electronically. And so, it's not a full look, and it's only 1 year, and happened to be a year where we didn't have final regulations. And so that's why I say it's dated, it's incomplete. But in that year alone, they found 24 billion was invested. And we also have a public look from the GAO, who just released a report a couple of months ago, and it was similar. They derived their data electronically, and they indicated there were 18,000 investors in 2019. A lot, 18,000, and came up with a number of 29 billion. So again, it's 75% of folks that reported electronically of their investments. At Novogradac, we started a survey before any public look, early 19. And our survey is primarily multi-investor funds. We receive data through direct survey, but we also receive data through public sources. And we've been tracking these funds. Right now, we're at 1,200 funds, about 1,200 funds that we track, of which 900 of those funds provide fundraising data. And like Jimmy said, 20 billion is where we are now on our report, raised to date. Now, again, there's no private funds in our survey, any sort of individuals that are investing for themselves. And so there's a lot of data that's not in our survey, but it does kind of give us a trend to look at, an increasing trend of that 20 billion. Just in the 6 months or actually 1 quarter, our last data is as of September 30th, 2021. So between June 30th, 2021 and September, there was a 15.8% increase in capital raised for our portfolio that we track the funds. And the number of new funds that we're tracking is 6.6%. So new funds keep being organized. The capital raise keeps increasing, and as I said, 2021 has been a great year. Some of the more granular data. I mean, most of these investments are going into real estate, and most of that real estate is residential real estate. And out of that 20 billion, 2/3 of the capital raised went towards some type of residential real estate. It may have been mixed use, but they had some type of residential real estate in their investments. So it's a lot of residential real estate. But we're seeing since the end of June through September, commercial real estate increased by 49% in our survey. And so anecdotally, it looks like the post-pandemic commercials picking up, and hospitality's picked up as well. That actually went up 100% in that quarter because of, again, the pandemic pause. So to sort of wrap up, 2021, as I said, was a fantastic year for raising capital. Myself, I'm noticing in my practice an uptick towards the end of the year here, because like Jimmy said, there's this 10% benefit that ends at the end of 2021. So if you hold an investment in an opportunity fund for 5 years, you receive a 10% partial exclusion, 10% of your original deferral. So you only pay 90% of the tax when you have to realize that gain after the deferral period in 2026. This is the last year to get that because we're only 5 years. Will be 5 years from 2026. And so we are seeing folks take advantage of that and investing early. And capital really just doesn't appear to be a problem in this program. There's plenty of capital. There's plenty of capital gains. I think folks have been taking gains from this long market run and really diversifying into real estate. It all kind of fits with opportunity zones at this point. I think the real pressure is on quality deals. Early in the program, lots of low-hanging fruit and opportunity zones, and now, not so much low-hanging fruit. So I think it's really important for folks to make sure that that they align themselves with funds that have a really good track record of finding quality deals and opportunity zones.
Yeah, really good points there, John. Thanks for painting that context for the backdrop that will of opportunity zone news that we'll kind of keep in mind as we progress through this webinar today. I agree with you. I don't think the capital raising is that big of a deal. I remember when the opportunity zone legislation was initially passed and the program started getting rolling. Now former Treasury Secretary Steven Mnuchin estimated that it would be a $100 billion asset class, and I think by the current estimates that we're seeing now, it looks like we're going to blow that number out of the water. So the issue really is sourcing good deals, and Pinnacle Partners and Javelin 19 Investments seem to have a pretty good solution to that problem. So Jeff, let me turn to you now. Your team at Pinnacle Partners is launching a new fund. It's going to be a multi-asset fund that focuses on multifamily projects, highly curated portfolio of multifamily projects, I should say. What can you tell us, John, about your new fund and that solution to the problem that John identified of there not being enough great deals out there? How do you source your deals?
Indeed. Well, Jimmy, thank you. It's great to be with you once again on an OZ panel. We're really excited to be launching our new Pinnacle Partners fund in collaboration with Javelin 19. I'll introduce Jill in just a moment. And as John described, there's a whole lot of capital interested in opportunity zone investing. You've got significant appreciation in the equities market, despite recent volatility. It's been a bull market. People are looking to harvest gains. Obviously, single-family residential real estate is appreciating at all-time highs. Crypto up 200% year to date. And so we're seeing a lot of people accelerate sales of these assets and seeking the tax shield that the Opportunity Zone legislation provides. It's the most compelling set of tax benefits ever enacted by the U.S. government. Now, because we've done a few of these in the past, we didn't get into the specific and discrete benefits, but as a reminder and a primer, you qualify, if you invest capital gains in an Opportunity Zone real estate project, you gain three benefits today. You get deferral of the capital gains tax, you get the 10% step up that John described expiring at year end, and then ultimately, and the most compelling advantage is you get tax elimination in the appreciation of the real estate over a 10-year hold. So we think this is the most compelling tax shield ever provided, and we've been executing on Opportunity Zone legislation since 2018. So as John described, enacted in 17, full-fledged policy in 19, but we took a bit of a risk and began executing with the first OZ deal in 2018. And we have since, I'll put a slide up here to speak to our experience and track record at Pinnacle Partners. We since have closed 8 what we call single entity assets. I wouldn't say we were cherry picking, John said low-hanging fruit, but indeed, we found some of the most attractive Opportunity Zone projects in the Western area, California and Washington specifically, and we've since capitalized over $500 million of OZ projects. Those projects will deliver 1,300 multifamily units to the marketplace over time. So we've been very focused on multifamily, as John suggested. We think the ideal product type for OZ investing, given the 10-year hold, and the ability to use residential real estate or commercial residential real estate as a hedge against inflationary environments. So we've been very, very successful as an early mover. And more recently, we've been getting investor feedback to not just have one deal at a time, which, by the way, required a lot of rigorous underwriting. And then we capitalized the project, again, one at a time. But our investors were seeking one more of a fund format where they could get instant diversification, but they also wanted to participate in the emerging markets that are benefiting from the migration that's occurred over the past 2 years. So we took that on board. Simultaneously, we had been collaborating with Jill in Javelin 19 for the past year. We truly had a model match in terms of investor feedback and requirements for OZ investing. Jill, very specifically, is a longtime developer, sponsored over $500 million of projects and some very notable OZ projects in the past 2 years. She also has an advisory service business that's been consulting with family offices and ultra high net worth investors seeking to invest capital gains into Opportunity Zone projects. So she's been kind of a vetting service on behalf of those families. And so we had a lot of like-minded approach, one to the underwriting, to an LP-centric sort of fund format, and the same desire to target these strategic markets that are emerging now with great demographic trends. So the combination of our collaboration is Pinnacle Partners Fund VIII. And it is, unlike other funds that are first kind of raising capital and then sourcing deals, as John said, the difficulty in this is acquiring and sourcing the highest quality real estate projects that stand on their own before tax benefits, even more attractive with the tax benefits. They generally add about 3 to 5% of the IRR to the IRR. So what we wanted to do is create a fund of 4 highly curated projects in these strategic markets, and then wrap a small boutique fund around it and provide the same sort of rigorous institutional underwriting that we always have provided and now benefited by Jill's team's expertise. Provide the visibility into the fund as opposed to some other funds that might be more blind to the assets that they will ultimately have in their portfolio. And then be very LP-centric. be light on our fees, be very focused on returns. And as the poll suggests, people are seeking the tax benefits, that's clear. They're seeking returns, and we're generating some very attractive risk-adjusted returns, particularly with a multifamily focus. That's our exclusive focus, residential properties, and the instant diversification across this fund of four. So that is what we have launched. We've received tremendous reception thus far. This fund is available for investment before year end to secure the 10%. And 3 out of the 4 projects are in our control. And we clearly have an edge, I think, in combination of Javelin and Pinnacle. And we've been able to source some of the most attractive projects in all of the 8,700 opportunity zones that exist nationwide. So with that, maybe I'll ask Jill to talk about that edge that we have in sourcing, how we attract and secure these high quality projects to create this this highly curated fund of four. Jill?
Great. Well, good to be with you all. And thanks, Jimmy, also for hosting again. And I think John will celebrate Christmas, is that January 2nd for all the investors who want to invest by the end of the year. So Merry Christmas on January 2nd. But good to be with you. I think, as we think about really our areas of expertise, I would break it up into really 4 areas: regulatory expertise, deal flow, investment acumen, and operational expertise. With our combined team, as Jeff had discussed, in terms of the regulatory expertise, we've been on the forefront of the Opportunity Zone legislation and regulations since they were passed, and working with excellent service providers and team members like Novogradac and others. And so that's one of the areas. And then secondly, in terms of deal flow and investment acumen, one of the benefits of Pinnacle having executed $130 million worth of Opportunity Zone deals is that the marketplace understands that when we're offering term sheets and when we're interested in deals, we have the ability to bring in the capital as well. So as a result, we've been able to work with developers directly. We've had brokers reach out as well in terms of our deal flow. And so we're really excited about the markets, and also being specific on the types of markets and the markets that we're looking at has been able to help us fill our pipeline. In terms of investment acumen, as Jeff has discussed, really my background is really institutional underwriting, and that's what I've done throughout my whole real estate career. And so kind of plugging in, and so with my team, as well as plugging into the Pinnacle team, we've been able to underwrite and vet a lot of opportunities, and we're really underwriting a ton of, first we say no to a ton of deals, then we underwrite a lot of deals, and it's really the few that make it through that we're offering term sheets are on. And then when we think about operational expertise, I think the one thing about a lot of the conversation with OZs is really centered on, just building the building and getting it stabilized. And I think sometimes a lot of folks don't think about what happens in years 4 through 10. Because there's value creation. It starts with buying the land right, and feeling really good about the basis and the fees and the ability to execute the business plan with the developer. But then you get to the point when the property's at stabilization, and that's when you need to maintain and manage the value and really kind of tweak and enhance the value as you go along. Because, when a property, when we look to sell it after year 10 at the appropriate time in the marketplace, the building will have several years of operations. And so we're really looking at operating partners, so developers who are also operating partners. And then we have the ability ourselves, having been asset managing properties as well as operating properties ourselves. So we have the ability to do that in-house for the right deals. And so I do want to just make sure that we are specific about our structure, and that is, we're viewing this as we're capital allocators. So we are allocating capital to a real estate developer, so best in class real estate developer for that market. And they are building the buildings. And then we are overseeing and paying attention to what happens with the business plan and helping formulate the business plan with the developer. And so I just want to make sure that it was clear that we're not the ones who are going in and building the buildings, but rather we're allocating capital after we underwrite and source the deal and underwrite the deal and find the right deal and negotiate the terms. We're allocating the capital to the developer. And then just wanted to touch on a little bit about our process. After the deal comes in and our initial underwriting, we are reviewing the reports. We're working with our service partners in terms of looking at the opportunity zone compliance. And then we're considering the developer's background as well. And so we go through a whole process before we get to the final underwriting for our investment committee approval. So just wanted to hit on those points. So maybe we'll go to the next slide and talk a bit about the market. So in terms of the areas of location, first, I would say we're thinking about the markets as Jeff mentioned. These markets have been the net beneficiaries of the population growth over the last several years. And part of the reason you have the population growth is that these markets have a higher than average percent of the population has a higher educational attainment percentage. You also have, when you look at the cost of living in these markets relative to the wage growth, you also have the cost of living has not outpaced what the wages are in that market. And so those are really, and then also just the population growth in itself. And so really what that creates are situations where it's almost an arbitrage where people are making great wages. They are, a highly educated workforce, but it's also relatively affordable with a lowercase a, affordable to live there. And, a lot of these markets we read about, Wall Street Journal, which is, or other publications where you're thinking about, Phoenix, Salt Lake City, Boise, people moving out from some of the West Coast cities to these mountain states. So maybe moving from a San Francisco to a Salt Lake City or Denver. And then, so those are the markets that we're highlighted here in the map that we're digging in on. And as Jeff mentioned, we have 3 that we're in negotiations and under control right now. And then we have a whole pipeline of deals as well. And so those are the markets that we're highlighting here, Salt Lake, Denver, Bozeman, Boise, Nashville, Seattle, and then also looking at Austin, Phoenix, Raleigh, and Charlotte. And then we have, potentially some other markets, but that strategically are the market selection. And then when you go a step beneath that, you have the markets, but then you look at what type of, is this a good location for the project? And what we're looking at are major employment centers, university, military bases. So for example, one of our projects is proximate to thousands and thousands of students attend several universities nearby. We also then look at, okay, now that we select the market, we look at the strong economic drivers. We're also considering, do the current market rents support new construction? So meaning, we do not want to make the market in a particular location. So what that means is we want to have the ability to comp out the rents to say, okay, here's our location, and if the building was built today, the rents would lease for, call it $2.50 per square foot per month. And we're able to point to a property, whether it's next door, whether it's a couple blocks away, but it's a really legitimate comp. We are not seeking to be have a business plan where we're building, say, $3 square foot per month rents. We're relying on those rents, and the closest comp, say, is $2.50, and we're trying to make the market, as the first mover in a location. So that's not what we're doing. We're really wanting to show and underwrite that if the building was standing here today, that the current market rents can support new construction, and investors are getting appropriate risk-adjusted return. And then also, as I mentioned, it's in the pathway of population growth and has strong public infrastructure and transportation resources. So those were a couple of points. I'll pause there for a moment. I don't know, Jimmy, if you have some questions, or you've said a lot, so I'll give you a moment. So.
No, that's great. Appreciate it, Jill. Thank you. Yeah, we do have a few questions that are coming in the Q&A, and I've got some questions as well. Just a quick reminder to all of our attendees, in case you joined us late and missed this announcement, we are going to save some time at the end for Q&A. So if you do have a question for me or our industry leading experts on this panel, please use the Q&A tool in your Zoom toolbar. It should be found near the bottom of your screen or the bottom of your app, and submit your question using that Q&A tool, and we'll do our best to get to it. We've got a lot of good ones that have come in so far. Jill, did you have anything else you wanted to add, or
maybe just one point on, in terms of kind of stepping back, how I'm thinking about real estate, and that is, I've been through a down cycle. So we've had the longest economic expansion, and I'll kind of take out COVID because it was maybe just a shock, but so we've had this longest economic expansion. And so when we think back, if we can remember back to the days of 2008, and that's really when banks weren't lending and the market really froze up. And so that it's something that as a team that we're very, very mindful of. And so what we're really trying to do is to underwrite in a way that is disciplined. And so, for example, we're not trying to grow rents faster than expenses. We're really trying to be mindful of that. We're also thinking about what the refinance looks like, and solving for the current underwriting for the agencies, whether it's Fannie and Freddie. And then we're also underwriting cap rate growth, so cap rates increasing over the 10 years, whether it's 50 or 100 basis points. So we're trying to make sure that the value creation happens when you build the building, and that we're operating it with our partner, and that in turn both maintains and grows the value as well. And that, in contrast to underwriting where the value creation happens through financially engineering or having a really low cap rate. And so those are the kinds of deals that we pass on, is a deal that hinges on a super low cap rate, or a deal that hinges on some aggressive refinance assumptions, or a deal that hinges on growing up rents at 3% and expenses at 2%. And so sometimes we'd rather present to our investors what we think on the deal really underwrites to, than say, really, leaning in with a very aggressive underwriting. Because, we just go back to and think about what happened to the downturn, and we think about also, what do we want to own during the next downturn? And so these are the types of assets that we think, these are durable markets, and these are institutional quality deals where you're talking about building, 200 to 300 or so units. And so it's an institutionally traded asset size, asset class in a market, in a location. And so that's also what we're thinking about, is just the liquidity in year 10, but having these durable markets and really building buildings with durable cash flow.
And if I may add, as Jill expresses our underwriting criteria and this discrete focus that we have in these selected markets, and our kind of long-term perspective through the holding period, that is why we did not launch a $1 billion fund seeking 10 or 12 assets. This is, again, we're overusing the term highly curated, call it a boutique fund of 4, because we thought that applying this type of criteria has eliminated a great number of deals. As Jill suggests, we say no routinely, and we're now down to a discrete funnel of very high quality projects in which we intend to capitalize just 4. So that's what kind of gave it this speciality, given the keen focus in underwriting and sourcing requirements that Jill described.
Yeah, and maybe just to underscore Jeff's point, it's the philosophy of, we're highly confident in transacting on these 4, and that we think with 4, maybe it's 5, but with that number of deals, investors are diversified, they get the benefits of diversification, and so we're sizing our fund to that. and then versus sizing the fund to how much money we think we can raise. So it's a different philosophy.
And that's why I said at the opening, Jimmy, we think it's the right type of fund at the right time in the OZ investing industry.
Yeah, that's great. I want to get back to an earlier point that you made, and you touched upon this already a little bit, Jeff, but wanted to revisit why the shift for you, for Pinnacle Partners, away from single asset funds into the multi-asset format. Was that feedback you were getting from your investors, or does it make operations easier? I'm just kind of curious to hear more about that decision.
Right. Well, because we started in 2018, as John described, the regs became final and formalized in 2019. We felt it was best to approach this on a single asset basis. So get in deep on one project at a time and then capitalize it accordingly. That would eliminate risk, while these regs were refining and improving and ultimately finalizing. So that is our heritage. I think it's great discipline. Our investors appreciated it, but as they became comfortable with our capabilities to execute, they said, and they were seeing these other markets emerge as attractive places to invest. They said, we really would like a small basket of diversified assets in those selected cities, with the same rigorous underwriting as you did on the single entity side, but make it a multi-asset fund. So we listened, and I think we're delivering that in this case.
It becomes more efficient for family offices and RIAs and just advisors in general, because after once they do the initial underwriting, you can do it once and you get 4 deals.
Sure. Are there any examples of specific projects in the fund that you can highlight? Anything you've identified in the pipeline that you can speak a little bit more about, a particular deal maybe?
Sure. Jeff, did you want to do that, or should I?
No, please do, Jill.
Yeah. So one of the deals that we're working on is a deal. I'm not sure if we should, but I'll just say a deal in Denver, and so it's in it's a multifamily project. It's about just over 200 units, and it's really walkable to the really downtown of there's a river system that runs through Denver. And so it's really walkable to that. And then in terms of how we're thinking about and how we're underwriting, we're really underwriting to current rents that are in the marketplace. And so we're out there and toured a number of the comps. And our partner is a very large national development and construction company. So that one we can share more about with the investors offline too.
Good. Yeah. So the question about the investors, actually, there's a multi-part question. So, and maybe this is for Jeff probably. I'm curious, what's the minimum investment for your fund? And also, second part of my question is, who are your opportunity zone investors typically? Like, what are the types of different capital gains that you see? Are you helping your investors defer gains from sale of stock or sale of small businesses or sale of real estate, or is it all over the map? I'm just curious to get the breakdown on that.
Yeah, so generally speaking, with some flexibility, we have a minimum of $500,000 to invest in the fund. We have a large base of what I call tech execs who have benefited from their publicly traded stock, and generally low basis, highly concentrated positions, seeking to diversify, maybe the first time into commercial real estate, and they want this tax shield, the OZ benefits, and then the ability to participate in institutional quality real estate. Increasingly, I will tell you, 2 categories of investors. One, crypto investors, because again, as I noted, 200% increase, and obviously there's a capital gain to be had there. And hedge fund managers who do a lot of active trading. And I think a lot of people don't know, John, I don't know if you see this in your practice, but it's not only long-term gains, but it's also short-term gains. So if you top tick Tesla 1300 most recently as a hedge fund manager, that would be a short-term gain that's taxed at a higher rate. And you could make an argument that the deferral is even more attractive, the 10 both the deferral and the 10% step up become increasingly attractive for that type of investor. Then we have, yes, the large episodic liquidity events, the sale of a business. We've seen a lot of people sell their primary residence, which is a taxable event, unfortunately. And then we have, straight ahead real estate professionals selling their assets and seeking, instead of a 1031 exchange, the more flexible OZ type investment vehicle, because it is indeed different. It does provide tax elimination ultimately, and a lot of flexibility in terms of investing only the gain and not your basis in the gain and the debt, and do a like exchange. So those are our investors, Jimmy. Quite a diverse group, all I think accelerating the sale of assets and seeking an alternative asset like commercial real estate, in particular multifamily, and the tax shield of the OZ.
Right. Excellent. Well, I think we'll stop there. Those are my questions. I want to turn now to the questions from our live audience. So first question, I'll keep it a really basic one. Is your latest fund currently open, or will it be available before the end of the year? And how does an investor learn more about placing an investment if he wants to get in before the end of the year?
Indeed, we are taking investment immediately and before year end to seize upon that 10% to qualify those gains, one for deferral and to obtain the 10% step up. I think if anyone's interested, they should contact, and you'll provide the details maybe in the chat, either myself or Jill, and we can go very deep into the pipeline. And we gave a preview to the Denver project, and then also talk about OZ in general if desirous.
Excellent. Yeah, I will.
We're launched and getting exceptional response.
Sounds good. Yeah, if you are interested in learning more, please do get in touch directly with Jill or with Jeff, and I'll provide their contact information in the chat in the next couple of minutes here. Let me move on to a question that we got in from Brad. Brad has a question about how you define a quality deal, and he provides some example numbers of what he might think is a quality deal, and was curious to get your thoughts and the thoughts of the other panelists. So 8% pref, 70-30 promote or less, development fee of 5% on hard costs or less, no entrance fee, a small exit fee, 1% over a hurdle, no asset management fee, no equity raising fee to sponsor. So those are some key numbers that
he's a sophisticated individual.
He definitely is. He definitely is. But anyways, curious to get your thoughts. Let me just get your thoughts on his numbers there.
Well, I think maybe what I'll do is I'll say the following, and then maybe we could defer, because there's a lot of metrics within that.
There were.
We believe we've got one of the most LP-centric fund formats available. As an example, our split is not 70-30, which he considers to be quality, but it's 85-15. 85% of profits after a preferred rate of return. He said 8, ours is 7%. But we're providing, we think, a very aggressive split of profits, 85% to the LP, not 70-30. All the other metrics are more deal specific.
I think Brad may have thought, I think this may have been his question about a deal, about how you define a quality deal, and not but in terms of like 70-30, so this would be, I think Brad was outlining the waterfall that we would pay, like the promote to the developer, in which case the developer, I think John was, I think Brad, you were describing so the pref would be an 8, and then 70-30 over an 8 with the development fee of 5. And I think, overall what you're describing, I would say it's kind of in the range. There's a lot to unpack in terms of fees and, and just, the land, whether they own it, so it's hard to say, but I would just say it's, from what you describe, I think it's kind of in the realm of market fees, but it's also, depending on the location, Austin versus Omaha. No offense to Omaha, but anyways.
So Jeff, how does Pinnacle Partners differentiate from like that typical type of fee structure? Are you guys average or above average or below average, or where does your fund fit in your mind? Maybe you can speak to that a little bit.
We think we're how do I say this? We're below market in some respects. I just quoted you our split, which we think is potentially one of the most aggressive in the market, that is in favor of the LP. So as I said, we formed this fund with a few tenants in mind, and that certainly was to be LP centric, to deliver a high rate of return on a risk adjusted basis without engineering as Jill was describing that some other funds do with cap rates and rent growth assumptions. So we think, in combination of our underwriting, our conservative return objectives, and the waterfalls and fees, that we're probably I could say leading the market in those certain categories.
One thing I see there's a question about a 10 to 12% IRR. It says there was a comment about the returns that we're solving for. And I would actually say the 10 to 12% IRR is actually high relative to the market. It's net of all fees. And so that I just think it's, if you're considering, if a developer, let me just kind of describe the market, which is there are developers who are putting together their own funds, in which case, a developer is raising money to fund all of those development projects. And then you have capital allocators that are raising money to allocate to developers for their development projects. The pro with allocating to groups like us, to capital allocators, is that we invest with developers at the appropriate time, like we're not taking development risk. We also have a lot of controls associated with our joint venture with the development, and we're also able to provide geographic diversity. But we're charging some fund fees, which Jeff outlines, and we also would argue that they're light. And then there is a developer promote. If someone is investing in a developer-led fund, one of the things to be mindful of is that the developer then would have all of the capital to provide and fund their deals, and there's not a group that is holding the developer's feet to the fire and saying, the budget came in, it's 25%, our hog costs are 25% higher. We really think we should put this deal on hold. There's not that kind of relationship with a group like a fund. So, folks need to decide what's most appropriate. And we're really, we really think the capital allocator and in that solving for in that range is very compelling in the overall marketplace.
That's a great point of distinction there, Jill. And I've found it's actually really, really difficult to compare different fund fee structures. It's oftentimes an apples to oranges comparison. For the reason you gave is just one of many reasons why that's the case. So, but thanks for your insights there. Wanted to move on to Jeff's question. He's piggybacking on Brad's question that we tackled a minute ago. Jeff asks us to please discuss preferred returns to investors, waterfall split, and the manager member fees. Secondarily, he asks, will each of the projects that are held are they held, hang on, he's got a little typo in here, I think. Are they held as a separate LLC with their own return structures, each project, or how does that work?
So maybe what I'll do is, and these are great questions, and I think probably best in conversation. So I'd invite Jeff to let's have a meeting to discuss all the various questions. What I would say, let's see, they're each in an LLC, a discrete LLC, that's certain. And then what we do is we present an aggregated return of the portfolio's performance. And that is the 10 to 12% net IRR. As Jill said, we think it's market leading, that return, net of fees. And that is before the tax benefits, which maybe John could opine, but most accountants would give a 3 to 5% increase to the IRR based on the tax benefits. Is that right, John?
I think I saw a nod from John.
Yeah.
Nod, that's a nod from John.
Yeah, that's a nod from
He's
John.
muted, he's unmuted.
I think there's several questions about, so the returns that we're outlining do not include depreciation. So that would, be further beneficial, but they don't include depreciation, and they do not include the OZ benefits. So this is, just the returns net of developer promote and net of fund fees. And maybe I think, Jeff, it would be helpful, I think, just to go back through the just the fee, like the asset management fee, or I'm sorry, the waterfall or the promote, if you think, because there's a number of questions about that.
Yeah, so it's our fee structure is very simple. It's a 2% acquisition fee. So that's what we get remunerated for to find these highly curated projects and then put them into the portfolio and provide the oversight as described. And then the ongoing asset management, really, as Jill says, keeping the sponsor to the business plan and ensuring OZ compliance each step of the way, because there's a number of tests over the period. And what we really want is to ensure, number one, everyone gets their tax benefits. And most importantly, we qualify for tax exemption at the end of the holding period. For that, we get a 1.5% asset management fee. That's what that is for, is providing the oversight on the execution and the delivery of an OZ compliant project. That's it.
Excellent. Let's move on to a couple more questions here. We got time for several more questions, actually. We're getting a lot of great questions in. So thanks for asking all these questions. Please continue to ask away using the Q&A tool in your Zoom toolbar. Chris asks a multi-part question here. He wants you to please provide more details on the pipeline, if you could, especially the 3 properties mentioned that Pinnacle has control of. What leverage or range is expected on those projects? And are you seeing deals that meet your underwriting criteria in Austin?
Well, I think Jill and I can bounce between the response here. I think she likes Austin, as noted earlier, and she could speak to that. I think on the pipeline, what we do is we want to, again, separately discuss that with an individual. So we seek that meeting. Jimmy, if you can put our contact details in the chat, please.
Yeah, I did just put Jeff's email address and Jill's email address in the chat. So please do feel free to reach out to Jeff and or Jill and ask to schedule a call.
And the reason why we typically take an NDA and want to make sure, before we disclose, but we always do, and walk through the pipeline one by one. And as we're suggesting, 3 of the 4 projects are in control. Jill can speak to the amount of leverage, which again is a conservative number in our opinion, and our opinion of Austin, if we can get that deal.
Yeah. So in terms of just the leverage, I'll talk about it in twofold. Number one, the construction leverage. And I would say it really, we're looking at about 60% loan to cost. And so I would say that's kind of what's in the marketplace. Maybe it's 65, maybe it's 55, but that's generally, these are non-recourse construction loans in the marketplace. And then how we're thinking about the refinance and what we underwrite is to really the agency underwriting. So we're looking at a 1.25 debt service coverage ratio or 75% loan to value, whichever is less. And we're really thinking about interest rates. We're increasing it to, in the range of around 4%. And so so this is really an amount and a rate that is a lot higher than what is in the marketplace. So that's how we're thinking about leverage and interest rate.
And if I can make a comment, Jimmy, a lot of people, they think the OZ real estate is unique in a couple of different ways. And what I always say is the OZ provides you rigorous kind of requirements around the site selection, right? There's 8,700 zones. After that, and assuming maintaining compliance, it performs like any other real estate asset, right? So it generates cash flow, which we distribute to our investors on a quarterly basis. And as Jill suggests, we refinance the construction loan, and then we return a lump sum amount of capital to our investors, generally between the second or the third year of the project life. And in our case, will be before April 15th, 2027, when the deferred tax is due, right? So we're generating a lot of cash flow years 3 and 4 back to the investor, return on capital back to the investor, and then ongoing through the 10-year hold period. But I just want everyone to know, this is just like any other real estate asset. You can refinance it, you generate NOI, net operating income. You can use depreciation to offset that income, which is not contemplated in our model. So that's upside. And then
the depreciation does not get recaptured.
Yep.
Depreciation does not get recaptured, unlike a traditional real estate deal, because you get tax elimination. And then, of course, we are seeking to sell the asset once we qualify for tax exemption to get maximum return.
I did want to touch on kind of I've been following the questions, but kind of 2 questions that came up. Somebody asked if we're considering projects in Reno. I'm sorry. And also Austin was the question. Oh, sorry, Austin. So the first one about Reno is easy. It's yes, we've underwritten a couple projects there. In terms of Austin, I've had investors invest in several projects in Austin, and it's just trying to find good deals. And so we'd absolutely welcome the marketplace. I've spent a lot of time looking at deals, and I've had investors invest in that marketplace. So we do like that as a market. And so if someone has a deal they'd like to talk about, we'd welcome that. And then there's a comment about inflation, and I'm trying to just see
there's a couple questions about inflation. Andy here asks, what effect would sustained inflation, say 5 to 7% over the next 3 years, for instance? What kind of effect would that have on your financial model or projections?
Yeah, so I think, one can't just look at one lever of the model and say, this goes up by 5 or 7% and the others don't, because by definition, that means, the whole marketplace and the costs are rising. And so, in short, what I would assert and what we've seen historically is when there is inflation on the cost side, then you also have inflation on the rent side. And it kind of, the higher inflation kind of goes in the model and has an effect of really, increasing costs and increasing rents and increasing expenses. And so what I would argue is that in some ways you kind of end up on a pro forma wise at an inflated model, but it's still, if a deal works before and the inflation runs through the model, things might tighten up, but it should still work. The question is what happens with cap rates. And so that's why, we're increasing our cap rate at year 10 at an exit. And we're also not trying to financially engineer or kind of underwrite a 4 cap or cap rates that are current in the market. So we take current market cap rates and then we increase those. And just one anecdote, for example, just to kind of make the point, in one of the markets that we're underwriting, there was a deal that directly next door to the project that we're underwriting, and it just traded. And we talked with the selling broker that had worked on the deal, and he shared with us, what it traded for. And he said, and this is a Class A newly constructed multifamily project that just traded. And he said, oh, by the way, you do know that after the sellers closed, they just increased rents by 8%. They did nothing. They just increased rents by 8%. And the renters are absorbing it. And not to say it's right or not, but my point is that, that though we're going to see that these rents going up. And so how we're thinking about it, what it really means is that we need to be constantly in the marketplace, looking at what expenses are, constantly in the marketplace with their property managers, make sure we're updating our salaries and on the expense side as well, because on the cost side, those as we've seen are people are trying to lock in the cost as soon as possible.
Yeah, I'll just make one simple comment on inflation. I think the key there, particularly with multifamily, which we believe is the most attractive product type, which is why the fund format is exclusively focused on it, is that it is a hedge against inflation, because yes, you will have rents rising. And we assume that we'll have fixed debt over the period, right? We'll do these refinances on a 30-year amortization, so we'll have fixed debt, which is just absolutely critical, of course, to the performance. And we think that's very, very doable.
Good. Well, we are at the top of the hour. So if anybody has to hop off, and Jill, I think you may need to go, we won't hold it against you, but Jeff and John, we've got a few more questions if you want to stick around for a few more minutes.
Absolutely.
Yeah, thank you.
keep going.
And thanks for your time. And my 5-year-old hasn't learned to drive yet. So I'll pick her up. So thank you all.
Thank you, Jill. Thanks for joining us today. And if any of the attendees have to go, we won't hold it against you either. But we've got several more great questions here. I wanted to see if we can get through them. John, I got a good one for you here. Chris asks, can you help us understand the differences from a tax perspective throughout the life of the investment for a QOZ REIT structure, 1099, versus a partnership structure where the investors would get issued a K1? What are some of the key differences there?
I think we did see some REITs early in the program. I think the main reason was for exit, and that it wasn't real clear on how to exit an opportunity fund and get the back end gain exclusion. When we got the final regs, we realized we could sell the real estate and that gain could be excluded if you didn't sell your interest in the fund, which could be a marketability issue. But there are some REITs out there. I think the biggest difference is, in a especially in real estate, in a partnership, you have debt basis, and that debt basis flows through the partnership to the partner. It can be used to absorb cash flow because it's basis, and can be used to take losses. You have basis in your losses. And the nice thing about opportunity zones is you can take depreciation, for the 10 years you're in the deal. And typically when you sell a real estate asset, that depreciation is recaptured, it's gained to you. That's also excluded in an opportunity zone structure. So you can take those losses through a partnership. And the REIT will get the losses, right? It doesn't flow through, you're just a shareholder. And so you're not going to enjoy the benefits of losses. You're not going to enjoy the benefits of debt basis. Any cash that comes out to you on your REIT stock that's in excess of your income, which a lot of times cash is greater than income because they have depreciation, it would be an inclusion event. So it's probably tough to manage. I don't have any REIT clients in this space, but those are, I think, the main differences: debt basis and the flow through.
Great. Thanks for those insights, John. Appreciate it. Joseph asks, this is a question for Jeff. Could you go through again which management fees are one-time fees and which ones are annual? Maybe just give a little more clarity on that.
The acquisition fee is a one-time fee. It's putting that portfolio together, all the sourcing, all the underwriting as described by Jill. And then the annual is the asset management, the ongoing oversight, execution of the developer's business plan. That is an annual fee.
Good. Scott asks, Jeff, this one's for you as well. Is the Pinnacle promote calculated on an individual property basis or a blended fund basis? And what he's getting at is, if one property underperforms, will you still get full promote on the others?
No. So the promote is calculated on an individual basis. Yes.
Okay. Let's see.
So no, we don't get. We must. The Pinnacle promote is at a point in time when we've returned the preferred accumulating balances, and we're still distributing profits. And until we get to a profit state, we don't enjoy anything.
Mm-hmm. Mark asked a little while earlier, and I think we answered this question already. Does the return include depreciation? I don't think your model does include depreciation.
So I think what Jill was saying, and I hope the audience picked up on the fact that we're very conservative on the underwriting. So we talked about cap rates. A lot of people, cap rates are, you hear of cap rate compression going down. That's to the benefit of the investor. Clearly, we think they rise. There'll be some cap rate appreciation. We're not, again, financially engineering those cap rates downward towards exit. We're also not putting any benefit to depreciation, as mentioned. We think that's upside to the pro forma performance. And then, we do a number of other things in the underwriting process that ensures the land basis is accurate and so on. So anyway, it's when we project a 10 to 12, which we think, again, is market leading, that's conservative underwriting.
Yeah, good answer there. Let's see. Seth asks, I think this is a pretty interesting question, actually. Could an investor choose to leave all of their funds within the Pinnacle OZ Fund 8 through the entire period the fund is active? And what he means by that is choosing not to receive distributions during that 10-year period, but instead having those distributions pile up so that none of the money is taxed at ordinary income rates. Is that?
Well, I've never. Oh, wow, that's an interesting question.
I've
never been asked that question, and we could take that on board, and we could speak to our advisors. Where I thought the question was going, because I do get this question routinely, is I don't want to sell after 10 years.
Right.
I want to keep holding the asset.
Let's ask that. Let me ask you that question in a minute. John, do you have any insight into that? Have you ever seen a situation of an investor choosing to not receive distributions, and how does that impact the taxability of those funds?
Well, the fund's a partnership, and so the income that produce those distributions, first and foremost, will be taxed, right? It's a flow-through entity, whether you leave the money in there or not.
That's right.
Okay, yeah. So it is ordinary income, and it just flows through to the investor.
Assuming typically
Okay.
your income is going to be less than your cash, depending on the debt service and the like. But I mean, and so yeah, rather than because if the distributions are in excess of income, there will be an inclusion event, a little bit of an inclusion event every time you exceed that if you don't have debt basis. But in a real estate deal, you're going to have debt basis most likely. So, I would think that the wise thing to do is take the money.
Because you're going to get taxed on it anyway at ordinary income rates. So you might as well take the distributions.
Right.
And Jim has used the term inclusion event a couple of times. And, for those that aren't practitioners or deep in OZ like we are, inclusion event is kind of a naughty term, right? And the inclusion event is something you don't want to impede upon your OZ tax benefits.
Well, so let me ask you the question that you thought I was asking you a minute ago, Jeff. What if somebody wants to let it ride for longer than 10 years? Is that an option, or what are your thoughts there?
So I'm going to kind of answer that in two different ways. I think, by the way, I don't know if John agrees. I'd be curious to know. I think there'll be an emerging secondary market for OZ investments over time. Like, this is the investment period right now. A lot of people getting involved. And then as time passes, people might want to exit a position for whatever reason, and there might be a burgeoning secondary market there. Alternatively, an investor may not want to sell because they have tax elimination on their side, and they continue to get great tax efficient income producing cash flows. And so we think there may be an opportunity for those types of investors if we can aggregate them in size. So we're cognizant of that for some, particularly if they have state income tax that they're managing. So we're looking at that very closely, trying to provide some optionality. John, do you have any comments on secondary markets or longer term holds beyond 10 years?
I mean, the fact that you can buy an opportunity fund interest, as a secondary purchase and still get the benefits. I think there's a possibility.
Good. Well, let's do one more question. And if we don't get your question, I'm sorry. We had more questions than we had time to get to all of them. We're already 9 or 10 minutes over. Please do reach out to Jeff or Jill directly. You can reach Jeff at pinnacleoz.com. That's Jeff at pinnacleoz.com. Or you can reach Jill at javelin19.com, javelin19.com, Jill at javelin19.com. And I've also put those email addresses directly in the chat if you want to copy and paste. So the last question we'll get to right now is from Brad. Again, thanks, Brad, active participant today. Would Pinnacle allow an investment directly into their QOZB entities or directly into the assets themselves for folks who already have set up their own qualified opportunity funds?
Yes, we will. Yeah, we've got really good expert advice from Novogradac and our legal counsel. They can accommodate a QOF. So you cannot invest a QOF into another QOF, which is what Brad knows. So a QOF has to invest into the QOZB, and we can accommodate that.
Excellent. Well, I think we'll wrap it up there. We're already 10 minutes
Great.
over.
Thank you,
But
Jimmy.
thank you, Jeff Feinstein, John Sciarretti, and Jill Homan today, and all of our attendees. Thank you for attending today's presentation on Opportunity Zone curated multifamily portfolio investment strategies and the announcement of the brand new Pinnacle Partners Opportunity Zone Fund 8 that is just launched and open to taking capital. Again, please do reach out to Jeff or Jill at their email addresses posted in the chat to learn more. And we'll get the recording out to everybody within the next day or so here. So thanks again, everybody. Appreciate it.
Thank you.
Thank you, Jimmy.